Good morning, guys. It's 9:45 in the morning here in London on Friday, the 5th of March, 2021. Did you have a good day in the markets yesterday? It was a bit of a wild one, wasn't it? And to be honest, I think that today could be a similar type of day. Maybe not as much momentum, but we have a big data release, an important one coming up this afternoon, which we'll be talking about in just a second. You could probably tell from the title of this video. But before that, let's catch up on a couple of the markets we were looking at yesterday. We can see here, this is the S&P 500 daily chart. That's of course US stocks. Yesterday was another heavy bearish day, although it did manage to pull itself back up off the lows, which was a positive end to the day, relatively speaking. And people that are bullish stocks at the moment will be hoping that we can have a positive end to the week by having a bullish day. And a lot of that's going to depend on what happens later on with the data release, which we'll talk about in a second. First of all, we'll have a look at US dollar yen, another one of the markets that we were looking at yesterday. At the time of the video that we put out, this was already seeing a lot of bullish momentum, but it actually only increased from there and became even more bullish. And you can see yesterday we closed, for those of you that follow the Duomo method, in terms of the triad of price action, about as bullish as it could possibly get. A lot of momentum there. And you can see today we're only part of the way through the day's session. There's a lot of time to go, but already the size of the move we've had is much bigger than plenty of the whole days we've had in recent times. So at the moment we're hovering around that 161.8 level. It is a confirmed level, but I don't see it really holding up the price with this sort of momentum. It's herd activity right now. What it's going to take is whatever the data releases later, it could reverse things. Because I think right now we're starting to get into that familiar territory we've been in before around the financial crisis, the quantitative easings that happened after that, sovereign debt crisis, even throughout this pandemic, where it starts to become like bad news about the economy is good news for the markets, because it means there's going to be a delay in tightening of policy. And that's a real concern at the moment. Is inflation going to rise quicker than people thought? Is tightening going to happen sooner than people thought? So it could be that if there's negative data this afternoon, it could actually be a positive thing for the markets, and vice versa. We'll see. In any case, it seems that this afternoon is going to be a big one. So basically, today we're getting figures on the US employment situation. For those of you that don't know, it's the non-farm payroll report, otherwise known as NFP. And even in normal times, it's one of the most important data releases on the monthly calendar, let alone at times like this when we know that it's an important data piece for the Federal Reserve and we're trying to sort of figure out what their future course of action is going to be. Now, obviously, in the first half of last year, at least from March onwards, the labour market pretty much went, for want of a better term, tits up due to things like the lockdowns and restrictions and so on that affected people's jobs. So throughout the second half of last year, the US actually started to get pretty decent momentum in terms of the recovery. But then over the past few months, that momentum seems to have died out quite a lot and the numbers have started to flatline. According to last month's release, just over 10 million people in the US remain unemployed, and that's just the official figures. The real figures are likely to be much higher than that, and in fact, even Jerome Powell from the Federal Reserve has also stated he expects the unemployment rate to be higher and has been higher than what's officially stated in the figures that we get in the NFP report and so on. So there is some making up to do if the US is going to hit pre-COVID levels anytime soon, and in any case, even in normal times, flatlining numbers aren't a good sign for the economy. So let's start by looking at the weekly jobless claims, as something quite interesting actually happened last week. Well, to be fair, as interesting as jobless claims can get. So they actually managed to hit a 3-month low, and other federal aid programs for unemployment also saw decreases in new claims. So that's a good sign for the labour market and could show that the tide is turning. But when we take into account some other data, it's maybe not so surprising. So although it's not a perfect relationship, jobless claims have been steadily declining alongside the drop in new cases of the virus, both of which peaked around mid-January. So something to keep in mind is that obviously there have been extreme weather conditions in Texas that could be distorting the numbers. And actually in Ohio, there's been a surge in new claims, but officials believe that this may actually be fraud. So if we exclude Ohio's jobless claims, the 4-week average has declined by 17%. Now, when we look back at January's NFP report, the reference week also aligns with the peak of the last wave. That means that February's reference week will come following a significant decline in new cases alongside the vaccine rollout. Another positive sign for the labour market is the increase in job listings compared to 1 year ago. In fact, every single state in the US is seeing double-digit increases, but it still remains below pre-pandemic levels. Now, that surge also began in mid-January following the peak of new virus cases, and Basically, industries which were hard hit, such as hospitality and entertainment, are showing strong improvement now. So ADP employment, which came out on Wednesday, also showed improvements in the private sector, but was still well below forecasts. However, ADP hasn't been such a good indicator of NFP over the past year, so we can't really give that so much credibility. According to Oxford Economics, they do see this as a potential turning point now in the labour market and expect a much more sustainable labour market recovery as we approach the middle of the year, essentially due to the fiscal support and again the vaccine rollout helping speed up that recovery and get things back to normal. So the consensus for today's NFP report is around 145,000 jobs added, which would be a huge improvement over the 49,000 from the previous report. And we expect that the labour market will improve from the previous one and will continue to improve in the future as long as the vaccine rollout continues without too many hiccups and the economy slowly starts to recover. So we've also got the stimulus bill, which is on the verge of being finalised. That's going to help the recovery and speed things up. But the issue now is what sort of reaction we'll get in the markets. Will the markets react badly to good news on the recovery? We'll have to wait and see. Anyway, that's all for now. So I hope you have a great weekend. Stay safe in the markets throughout that NFP release and anything else that's going on. And let's keep an eye on what happens next week with the Federal Reserve. Will Jerome Powell say anything? Will anyone else from the Federal Reserve start to calm things down? We'll see. Have a good weekend. I'll see you next week.